Good morning, everyone. Welcome to Andersen Nigeria's webinar series. It's been a while since we've had a webinar session. We used to have this more often a couple of years ago during the pandemic and post-pandemic period. Today, we are going to be looking at a very important topic. This year being a transition year where there's going to be a transition from the current government to a new government. It's important that we look at the potential economic implications of such a change. And that's the reason why we felt it very necessary as part of our thought leadership initiative to have this webinar. In terms of the agenda for this webinar, I'm going to hand over to our managing partner very soon, Mr. Olalaye Adibiyi, to give some introductory remarks. Then I'm going to take over again to come up with some kind of introduction to today's session and introduce the panelists. Then we're going to have a very important, presentation on the economic outlook by one of our panelists, the renowned economist, Dr. Ayodele Teriba. And then we'll move on to the panel session, where we'll be discussing on some of the key issues that could impact the economy for the rest of the year and beyond. Right after the panel discussion, we'll then leave some time for some Q&A sessions where we'll take a few questions, that we'll get from participants, and then we'll wrap up. We hope to stick to time. We are looking at covering this within 2 hours. So try as much as possible to be efficient with our time and make sure that this discussion is very insightful. So without much ado, I'm going to hand over to my managing partner, Mr. Olalaye Adibiyi. Thank you.
Thank you, Josh. Good morning, all. My name is Olalaye Adibiyi. I'm the co-general managing partner for Africa for Andersen. Andersen journey started in Nigeria in 2017. I think exactly July 5. We are now in 47 countries in this continent. So thank you. Nigeria is the leader in this regard. I'm honored to welcome you all to this critical discourse on Nigerian Economy Outlook, evaluating post-election road to recovery and resilience. So in the coming hour or two, as Josh mentioned, we'll be privileged to listen to erudite speakers who will be introduced to you by Josh, who are all accomplished in their fields. And they will give their thoughts on where the kind of changes we are looking for, the kind of policy that needs to be taken to move the economy forward by the new government. Every change of government provides opportunity for an economic reset in our interconnected world. In the last few months, 3 banks collapsed in the US: the Silicon Valley Bank, Signature Bank, and the First Republic Bank. You already in the news, had in the news, major economy all face inflationary growth that tested their central banks, ours included. The outgoing government faced major economic headwind on its way out after 8 tumultuous years, and passing the baton to a new government which could not have come in at a more challenging time in our history. So I said, Nigeria is at a crossroads. What are we going to deal with? There's first subsidy, multiple exchange rates, infrastructure development that pays when compared to smaller economies, either on roads, seaports, or airports. We have a crumbling public educational system. So where are we going to start from? So I envy neither the outgoing or the incoming government. I can say both deserve a pity. We should all be ready to provide necessary support when called upon to do so, starting with this webinar. Ladies and gentlemen, as we navigate through this webinar, I encourage each and every one of you to actively participate, share your thoughts, and engage by asking necessary questions and at least provide solutions. Don't just ask the questions. Sometimes it's also better when you offer solutions to the problem that we're identifying. Together, let's foster an environment of growth, collaboration, and exchange knowledge. So we can also identify actionable steps to support Nigeria post-election road to recovery and resilience. So without further ado, I hand over to Josh to anchor this program and introduce the panel, other members of the panelists. Thank you so much, everyone, and welcome to our webinar, post-election. Thanks.
Thank you very much, Mr. Olalaye Adibi, for the introductory remarks. I think you've actually laid the foundation to commence this very important discussion. You all will bear with me that, the global economy has been facing some challenges in recent times. If you look at the past 5 years, there's been one external, or what we call exogenous shock after the other. And what that means is that if you don't have a very robust economy with very sound fundamentals, then you're going to face challenges within that particular economy. Just to bring your mind back a little bit, it wasn't long ago, if you look at the Nigerian economy, that we were impacted by the oil price shocks, where there was a significant decrease in oil prices in such a way that if your economy that is highly dependent on crude oil exports, then you are adversely impacted. So Nigeria experienced its first recession in recent times in 2016, where we experienced 3/4 of contraction of economic activities. That led to significant unemployment challenges and worsened, our, human development indicators. We were hoping that post 2016, the economy would get back gradually to the pre-2015 era, where the economy was growing on the average of our 5% GDP growth rate. Even though the growth rate was sluggish, we're hoping that by now we'll be back to those pre-2015 era. But what we also experienced in 2020 was another exogenous or external shock, this time in the form of a COVID-19 pandemic that came with its own challenges. It led to some nations pretty much grinding to a halt when it comes to level of economic activities. Once again, Nigeria wasn't left alone. We experienced 2/4 of contraction in such a way that the year ended, with a negative growth rate when you look at the annual GDP growth rate of, I think, about negative 1.9%. So clearly, we've had our challenges. Once again, come 2021, we're hoping to get back to good times. Luckily, we had some significant bounce in 2021 when you look at the GDP growth rate, but more based on the base effect. We're able to grow by a little bit over 3%. Now, what we're hoping to do was sustain that. You look at 2022 GDP growth rate, which ended, I think, by 3.1%. It was a sign that hopefully we'll be able to get back to around 5%. But once again, there was another exogenous shock. This time, the Russia-Ukraine war. But it came with a whole different challenge. Even though this time the focus wasn't on economic activities, it's on the other macroeconomic evil, which is inflation that impacts cost of living. As Mr. Laye Adibi introduced or mentioned in his introductory remarks, what we've seen globally is high inflation pressures across the globe. And Nigeria hasn't been spared. If you look back somewhere around January 2022, inflation was around, I think, 15.6 thereabout. Today, as of April 2023, inflation rate is around 22.2%, which means that cost of living is very high. What are the implications for businesses and individuals in the household sector? For businesses, because inflation rate is high, the Central Bank of Nigeria has had to respond in order to curb that. To do that, what they usually implement is a contraction monetary policy, which means that they have to increase the monetary policy rate. And once the monetary policy rate goes up, other interest rates in the market also do go up. So prime lending rates are high, and that adversely affects businesses and the ability to invest, to expand, and to really spur economic activities. So yes, we have a different exogenous shock, but it's also having an adverse impact on the economy. Now, if you look at other macroeconomic indices that have implications for our business, such as exchange rate, we don't have a very great story to tell. As Olaleya mentioned in his introductory remarks, we have multiple forex windows. Whereas the official rate might not look as alarming, $1 to about 416 naira. If you look at the market where most of businesses actually trade, which is the power market, you have an exchange rate of $1 to about 760 naira. There's clearly shortage of forex. And later on, we'll talk about some sectoral impact. If you happen to be in the manufacturing sector, for example, where you are highly dependent on importation of plant and equipment as well as raw materials in terms of your production processes, then you are adversely impacted. You look at the data on a sectoral basis, you see a lot of volatility in such markets or sectors, and those volatility do not bode well for foreign direct investment as well as domestic investment. And that's why Nigeria, which is supposed to be a great nation in terms of foreign direct investment attraction, cannot boast of such in recent times. So really, it looks like almost every major economic indicator is against us. I know my colleagues, who are most of them, tax accountants, would want to hear about the budget. Let's look at fiscal policy. You look at the budget for this year, 2023. Our estimated revenue is around 10.5 trillion. But our estimated expenditures is somewhere around 21.3 trillion. You have a budget deficit of 11.1 trillion, which is higher than the amount of revenue that you intend to bring in. What does that mean to you? That means most of these particular expenditures are going to be financed through debt. Now, today, our debt to GDP ratio, the indicator that most economists and even the some of these agencies that come up with credit rating look at, it's not that bad, 36% debt to GDP ratio. But when it comes to your day-to-day financing of your debt, about 96% of your revenue goes into deficit financing or the debt financing. What does that mean? That means the recurrent expenditures as well as the capital expenditures that we need to actually grow the economy are all going to be funded by different means. That is debt. That means by and large, sooner or later, we're going to have a debt distress challenge. And if you're looking at what is happening to a neighboring country such as Ghana, where they spent their way to high growth rates for a period of time, and then the debt challenges came knocking, and they didn't get access to capital markets, what we've seen is a great economic collapse. Nigeria doesn't want to get to that point where we cannot actually grow the real economy because we mismanage our debt. So if you look at all these macroeconomic indicators, they are not telling a great story. But I don't want to be the prophet of doom. I believe that within all these challenges are opportunities, especially for the business sector. And that's the reason we're having this particular session. So what this session is going to do is to present to us, our current economy and the outlook, because we have an opportunity here. By the end of this month, we're going to be ushering in a new government. This government came up with its manifesto. There are policies that they promised to implement. So I have very seasoned professionals here who are experts in their own right, in their own fields, to discuss some of these economic issues that I've mentioned, and also look at some of the promised policies in the manifesto of the incoming government. And then we can then assess, the potential impact on the economy as a whole, as well as specific sectors of the economy. So that as participants, our expectation is to be able to learn from this and be able to identify the areas of opportunities and make proactive decisions in order to maximize on some of these potential policies that will be coming in. So I don't want to become the lecturer here because I have more seasoned economists here. So let me move on to introduce our panelists, and then we can move on with this presentation. So I'm going to be very brief with my introduction because we have a lot to discuss today. First on the list is Dr. Ayodele Teriba. This is a renowned economist, somebody I'm very proud of because I quite remember when I came to this country and I was with my former firm. We had a presentation at I think the Nigerian Industrial. There was a session, a forum. I happened to be one of the panelists. I don't think Dr. Teriba will remember me, but I really, really admire his contribution to that discussion. So Dr. Teriba is the CEO of Economic Associates, a renowned economist, and he's going to share his wealth of experience in terms of his understanding of the Nigerian economy and how he sees the outlook for the rest of the year and beyond. We're really going to dedicate some time for Dr. Teriba to give us a short presentation for about 20 minutes about his thoughts on the economy and the outlook. Right after his presentation, we'll then move to the panel discussion session. And those who will be joining us during the panel discussion include Mr. Ni Yusuf, the chairman of the Nigerian Economy Summit Group, as well as the managing partner of Veraki Partners. This is another person that I've admired a lot. Almost every year I do attend the NESG, and I think the NESG has done so much, to try to steer the economy in the right direction with some of their recommendations that they prefer to the government. So I believe clearly, and you agree with me, that Mr. Ni Yusuf will be in a good position to share his thoughts, coming from both the business perspective as a consultant, as well as the chairman of NESG. Third is Ms. Shewun Oni, CEO of AG Leventis. Clearly, we cannot have a discussion about the economy without looking at some of the implications for a very important sector of the economy, such as the manufacturing sector or the trade sector. The manufacturing sector is a traditional sector, right? The traditional sectors are clearly agricultural sector, manufacturing sector, trade, sector. There are newer sectors today that are making a lot of noise, like ICT, all right? But we always need to pay attention to some of these traditional sectors. The reason why manufacturing for me is extremely important, especially when it comes to development of our people, is the ability for it to create job opportunities for people with different backgrounds in terms of skill sets. White-collar jobs, blue-collar jobs, the manufacturing sector is the one that can really absorb most of these people who are not privileged to have the level of education you and I do. So Ms. Shewun Oni will basically do justice in terms of looking at some of the implications of some of these policies to that particular sector. And there's no way you can talk about the Nigerian economy without talking about the energy sector, oil and gas. So we have the honors of Mr. Kayode Olatubushon, CFO of First Hydrocarbon Nigeria, who will do justice to that. I've had interactions with Kayode in the past, and look, I became a student immediately. He's going to share his wealth of knowledge in that sector. So without much ado, I'm going to wrap up and leave the floor, the virtual floor, to Dr. Ayodele Teriba, who have his short presentation before we commence with the panel discussion. Thank you very much.
Okay, good morning, ladies and gentlemen. Thanks to the Andersen family for the invitation to come and be a part of this conversation. And it's quite an appropriate time to take a look at Nigeria's economic outlook. I hope that I'm sharing my screen.
You are, but I can put it in presentation mode. That'll be helpful.
Okay, I will do that.
All right, thank you.
Thank you. Thank you very much. Dr. Josh has helped me to do a lot of the difficult work in that he has summarized the issues. He has summarized them quite appropriately. So I really don't need to dwell on them in these 20 minutes or less that I'm allowed to take to try and paint the big picture, to set the stage for the discussion by our distinguished panel. So I'm going to want us to think about issues across 5 major headings. The global outlook, which Dr. Banfo has summed up the shocks on the global scene since 2016 through 2020 till date. And I think that's quite perfect, So the global scene offers us some perfect storms intermittently. And so the job it leaves for us is, well, how do you cope with the storms? But more importantly, the storms are usually, however severe, short-lived. So the pre-shock situation will have to be, contrasted with the post-shock situation. And most shocks often involve contraction. So the question is, how long does it take for you after a shock to get back to the pre-shock level? And do you then achieve better than the pre-shock level before the next shock hits? Experience is the best teacher, so nobody can lecture any of us about the impact of shocks. We've lived through the pandemic, and we are all witnessing the ripple effects of the current geopolitical tensions, especially the cost shocks, the shock to energy prices, the shock to food prices, the shock to interest rates, even if that is triggered, by the choices of central banks, and the shock to exchange rates. So the question is, how is the country, that takes me to item 2, how is the country faring in the eye of the storm? And you can then go to the state, how are states faring in the eye of the storm? And then you can go to the companies. How are companies faring in the eye of the storm? How you fare in the eye of the storm is important. The storm, presents you shocks to your transactions. It presents you shocks to your portfolio. And well, let's partition it. Transaction shocks hit your income statement, and portfolio shocks hit your balance sheet. And the 3 different shocks that we've seen had different severity of effects on both income statement and balance sheet. So you take the stock. How has Nigeria's income statement been affected by the shock? You talk about budget. Nigeria typically situates its budget in the income statement, but it's not just every entity has both an income statement and a balance sheet. So you ask the question, which one has been more vulnerable, income statement or balance sheet? Then the important question, how can you soar above the storm? And again, I would like us to think in terms of, where do we have the levers that can help us to build resilience? Are they on the income statement or on the balance sheet? And with that, we'll look at country, states, and companies. And of course, we want to conclude on the note of, given these frequent changes in directions of the winds, which is beyond our control, how must we adjust ourselves? So I'm reducing, this narrative about the outlook to 2 things. What challenges are the shocks presenting to you? That's one. And the second is, what levers can you adjust? How can you adjust your sales, to cope, with the storm and still continue your journey? It's not all the time, when you get headwinds that the ship, they typically will never say we are turning back, that we can't continue with the journey. They will be saying, oh, the storm is severe, the directions of the winds but almost always they find a way to adjust their sail and continue their journey and get to the The same with aviation. So headwinds, you can't wish away, but when they come, you then ask the question, how can we cope with it? So I turn to the global. It's important that we agree not just on what has happened, but what might happen in the next 4 years. We have a new government that has been elected. They will take over at the end of this month, and they'll be worrying about how to steady the ship of the nation for the next 4 years. So it's appropriate for us to have some notion of where we think the world economy will be headed over the next 4 years, before we then look at what they should do. Leaders have been elected at the national level, leaders have been elected at the state levels, and the rest of us have one company or sector to manage or the other. So we'll be trying to. Now, the picture that Josh has painted, if you look at the charts before you from 2017 or 2016, you will find there are two variables that we are following. We are following the oil price and the global equity price, which one summarizes what's happening to transactions and the other summarizes shocks to portfolios. And they map directly into two quantities. Commodity prices or oil price map into world exports, and global equity index map into world FDI stocks, world equity stocks. So I'm saying one of these prices connects with the balance sheet. So the equity price connects with the equity stock on the balance sheet, and the oil price connects with the exports on the income statement. And the key question is, if you look at 2016 to 2022, or even 2023, one of those two prices had been more volatile than the other. So the shocks have tended to be a bit more severe on transactions, on income statement, than they are on portfolios or on balance sheets. Across 2016, 2020, the lockdown, and even this, the global equity price has been more resilient. Typically, the book starts to decline, then the commodity price will decline more steeply than the equity price. Then the equity price will recover more quickly than the commodity price. So it's saying to you that the shocks are more severe on transactions or on production or on exports, and the shocks are milder on balance sheets. So keep that in mind, that global shocks have been a bit more severe. The headwinds, the income statements have faced severe headwinds. It's difficult to grow revenue. It's been difficult to keep margins, and in particular, in the face of the cost shocks of 2022 into 2023, in particular, margins and the sales growth have been under severe attack. It doesn't matter whether this is about production or about trading. Balance income statements are under threat. But so if you look at exports, therefore, from 2016 to 2022, 2023, it has stagnated. That's on the world scene. And if this is true of the world, it's true of most countries, if not true of all countries. Even the biggest exporters in the world, United States and China and United States, China has more exports than US, have been at each other's throat. Trade wars, we are not blaming anybody for. It's not really something you blame anybody for. It's global reality. But point exports have been difficult to go. What's happening to export mirrors what's happening to industrial output, to agriculture, that you have this slow growth, warnings about GDP contracting, warnings about the imminence of global recession and the rest of it. But if you look at what's happening to world equity stock, from 2016 to date, it has grown steadily. And if you now try to project the paths of the two to 2027, the trend of the last 5 years, even if you allow optimism for exports, are going to continue. There are going to be less opportunities for growth on the income statement than there will be for growth on the balance sheet. World equity index might well world equity stock might well double, between 2020 and 2027. But world exports are going to remain very sluggish, with implications for every country, for every company. So let's look at what that means for the country. Stagnant or declining income statements, whether we are talking about the levels or the margins, explains falling revenue that we attribute to Nigeria. Depends on oil exports significantly to find government revenue and foreign exchange. So when you say falling revenue, dwindling reserves, you are referring to the facts that Josh has summarized since 2016. From 2000 to 2014, we were not talking about falling revenues or dwindling reserves. The opposite was the case, because favorable commodity price improvements grew income statements without that much effort from all of us. For the same output, you earn more income, you got more margins. The tide turned in 2014. And Nigeria has largely coped with that falling revenue by running deficits, or if you like, issuing IOUs against expected revenue. And now the IOUs, the obligations on the IOU, particularly the interest obligations on the IOU, is beginning to become as large as the current revenue. So you had used IOUs to spend your today's revenue, you had spent it yesterday. And now interest payments is threatening that by the time you pay interest, you have no money left out of today's revenue. And of course, the reserves as well. Now, so Nigeria's problem arising from that change in global tide, the headwinds that our income statement has been facing, creates illiquidity. And that's Nigeria's, main problem, if you like, only problem. So whether you're talking in terms of revenue, you're talking in terms of reserves, it's about illiquidity. Now, the other things we describe, the exchange rates, the devaluation, the inflation, the recession, unemployment, poverty, and the rest of it, are mere symptoms of illiquidity. Therefore, what the new government that is going to take over the saddle in Nigeria needs to do is to find liquidity. Government has been trying to stem the revenue decline by introducing either new taxes on sugar, on alcohol, on tobacco, or raising old tax rates. We do a finance act every year. We need to realize that what's affecting the government is affecting all the companies and is affecting all the households. Revenue declines are global reality. So expecting that you will find more tax revenue in that context uh, may not be quite appropriate. So much as we've searched, there's no evidence that we are getting more taxes, except we are under the illusion of just looking at growth in Naira taxes. If you convert your taxes to dollars, you probably have half the revenue that you used to enjoy in 2016 today. And that decline will continue. So you need to look for something other than tax as a revenue source. And I'm saying the shocks to your income statement, your balance sheets are more resilient. Turn to the assets on your balance sheet and unlock revenue from them. Government at all levels own land, they own buildings. Are they net rent payers or net rent earners? You need to ask that question from yourselves. There are countries like the UAE or states, city states like Dubai, who don't even collect income tax, and largely profit taxes are not a major source of revenue for them. But they are more buoyant, they are more liquid than countries who collect taxes because they earn more from fees, from rent, from capital gains. So key question for Nigeria is what you own may be the answer to the difficulties you are having with revenue declines. And what you own may be the answer to the difficulties you are having with what you owe. So both to solve the low revenue, unlock revenue from assets. Nigeria has corporate assets, Nigeria has real estate, Nigeria has infrastructure that we can unlock perhaps more revenue than we can get from taxes from. We are not taking those seriously. So you need an annual investment act to complement the annual finance act. Second, all countries more or less borrow. And since the shocks of 2016 through the pandemic, most countries borrow more. And some of Nigeria's peers, Malaysia, Saudi Arabia, borrow more heavily than us. Malaysia and Saudi Arabia's debt stock are twice that of Nigeria, but their debt costs are not as high as Nigeria. Let's learn from that. Debt sustainability has to do not just with the level of your debt. Malaysia has a smaller GDP. It has twice our debt. But nobody is flagging them as having debt problem because they borrow better. And when you borrow better, it means you are not just issuing IOUs against income that the whole world can see that is declining. They don't issue IOUs. They don't borrow against income, but they borrow. And they do so more heavily than us. They borrow against assets. They issue sukuks and sukuks, forbids promissory notes. Sukuk compels you to put an asset that is going to yield profit and recover the principal, which is borrow, use asset-linked debt rather than IOUs. And typically, the Saudi Arabian debt issue or the Malaysian debt issue will be rated investment grade by leading international credit rating agencies, which means that they borrow like less than half of the rate at which we borrow when we issue IOUs. So cut down the cost of your debt, pull back from issuing IOUs, particularly now that Nigeria is beginning to get downgrades from, serial downgrades from, a growing list of risk rating agencies. And the third point for Nigeria is once you are issuing asset-linked debt, you are one step away from equity because most asset-linked debts are convertible into equity. So issue equity. Why are you talking only about debt. Always only debt. Never speaking about equity. The Nigerian government dominates all the issues in the bond market, has no issue on the stock exchange. The Nigerian government goes only to Eurobonds market abroad, never, speaks about trying to issue FDI. And since 2016, many of our peers have shifted away from emphasizing debt. They shifted to equity. India, Brazil now gets like 100 billion US dollars in equity each year. They both have a portal where you have like 15,000 local assets that they are trying to connect with global liquidity. Saudi Arabia has followed suit. They too now have a portal where they are trying to connect local assets with global liquidity. Saudi Arabia has turned to its corporate assets. They did IPO on Aramco. They're doing a new one. Nigeria has such corporate assets. Nigeria has real estate assets. Nigeria has infrastructure more than Saudi that we can, turn to create portals like the India Investment Grid or the Brazil Partnership for Private Investment. So the conditions that the global shocks present Nigeria are very grim. I'm not disputing them. The revenue problems are severe. The debt costs are severe. The dwindling reserves, which has weakened the naira, very severe problem. But Nigeria has a choice. And thus far, we suffer because we ignore the obvious choice that we can make. The world is not promising any country fast growth in export revenue. The global environment is not promising everybody fast growth in GDP. The warnings out there are that global recessions are likely. Again and again, multilateral agencies, they mark the growth forecast down. That's the reality for the world. What the world is promising you is that there's a liquidity glut, and that liquidity glut is ending up in foreign direct investment in destinations that are open to them. Foreign investment doesn't just arrive. India is attracting foreign investment because they offer equity investment opportunity. Brazil offers, Saudi offers, Egypt is offering. Nigeria never offers. Most of the destinations of big foreign investment into Nigeria are in infrastructure space, which are government assets, which government has monopoly over. You have opened telecoms and you never regretted it. How soon are you going to open rail? How soon are you going to open power transmission? How soon are you going to open the airports, the seaports, the roads for foreign investment? Learn how India and Brazil have done it. This is the message, for Nigeria at this time, that we bewail headwinds on the income statement, but we ignore tailwinds on the balance sheets. We keep wishing that the oil price will come back up. Yeah, we work in concert with OPEC to try and do production cuts to firm up prices. But Saudi Arabia benefits perhaps more from OPEC than us. They export 5 to 10 times, they produce 5 to 10 times the oil that we produce. But they are not ignoring opportunities on the balance sheet. And it's that opportunities on the balance sheets that is keeping them afloat, that is giving them positive risk ratings. Because if you look at Saudi's GDP, today it is just still about $850 billion. But 5 years ago, nobody knew what Aramco was worth. They've taken Aramco to the market, and it was said to be worth at the point of IPO $1.7 trillion US. That's twice as of 2020, twice of what their GDP is today. Since then, it's grown in recent times to $2.4 trillion. So by turning to the balance sheet, Aramco unlocked, if you like, between 2019 and today, $700 billion. They will never have found that if they were focusing on income statement. Such opportunities can only be found on your balance sheet. So any asset that you own that you have not established its market price, real estate, companies, infrastructure, is as good as you not owning it. People will keep pointing to the debt that you owe. People will keep pointing to the interest that you pay on your debt. Whereas you are the one who is shortchanging yourself. Because if you care to establish the market value of those assets, then nobody is going to be comparing your debt to your GDP. Because the correct variable to compare your debt to is your assets. As long as you have more financial assets than you have debt, you are solvent. And so I'm saying that Nigeria has kept the door closed, against itself up till now. If the new government wants to reset, you need to do what your peers were not doing prior to 2015, which they are aggressively doing now. Brazil has created its portal post 2015. India, stepped up is in their investment grid post 2015. Saudi joined the ranks maybe 2017, and they all have good results to show for it. And they are all doing more. The Saudi is doing a new IPO this year, this month. So they are all doing more in that direction. And I might want to punctuate it here and let our distinguished panelists weigh in on the subject. If we need to, I can make further references to the single page summaries I've provided for the subnational and the single page summary I've provided for the corporate. The central thoughts do not change across countries, states, or companies. And, they are summed up on this page where I say, how do we adjust our sales? Rely less on your income statement. Rely less on shrinking incomes from producing or trading output from, agri industry services. Margins are shrinking, and volumes, are harder to grow. Rely more on your balance sheet, on your asset portfolios. Rely more on expanding incomes from assets, the assets needed to generate output in agricultural industry. You have companies. Saudi had always had Aramco. They had been contented with the sales revenue of Aramco, the export revenue of Aramco, until 2014. And they realized that if they expose themselves to the vulnerability of sales revenue and export revenue, the national ship will be at risk. So they've opened the door to the asset value of Aramco, so to the portfolio value of Aramco. So every company, and once you're talking of a company owned by a country, you should compare them with leading global companies. Which of the top 10 companies in the world today relies exclusively on its income statement? Most of them unlock more liquidity from the asset value of their company. And I'm saying rely on your companies or the places that you own. It could be, it's the time to make money from placemaking. Look at the buildings that, for example, the government of UAE, has, or the government of Dubai. Or look at the fact that they've made obscure cities to become global cities, to reposition those places to become global financial centers. And, so we rank when we are looking for drivers of economic growth, we rank companies, we rank cities. So what cities do we have that we can promote their place value? What locations can we brand? You can create premium places, brand them, and unlock revenue from them. The way if a five-star hotel buys a piece of land from the state, they begin to unlock money from them about the adjoining property, which are not, you are not investing or branding their place value, don't generate anything. Or it could be spaces. So it's not just cities, but activities are migrating from place to space. Whether you are operating in agriculture, industrial services, you part with a lot of the money you used to keep now for platforms, e-platforms. So the owners of companies, the owners of places, the owners of spaces walk away with most of the margins, not the people who come to the place to produce or people who come to the space to produce, and the owners of skill also walk away with a lot of the margins. So I'm saying what you own, all these four are balance sheet items. So what asset you own, regardless of whether you are the one who uses it or you let other producers or other consumers use it, which is how cities go, which is how electronic platforms go, or skills, whatever you own and you create premium brand out of is a bigger ticket to wealth, to liquidity, than what you use to produce. Many of the owners of these assets don't use them. They leave them open, to people who want to sell on the platform or who want to, have leisure on the platform, whether you're a buyer or a seller, but they make their wealth from having, an asset that anyone that wants to produce or consume find indispensable. I want to leave it at that. I thank you very much for your kind attention.
Thank you very, very much, Dr. Ayo Teriba, for this very insightful presentation. I mean, I'm totally blown away. This is a very different perspective that you've actually presented to us. So we're going to commence our panel discussion. And I think it's just fair that I take you from the presentation and let the first question go to Dr. Teriba. So what I take from this presentation clearly is the fact that when you look at global shocks today, on over time, if you look at the trend, the impact usually is on transactions more than equity or some of the assets. So rather than being overly dependent on these our transactions or production or income from our income statement, why don't we also look at returns we can get from the assets, equity, which are less impacted when there are these exogenous shocks, because these shocks are going to come anyways, right? So clearly, and there's another thing that you talked about that really hit home, all right? The fact that, yes, all these macroeconomic indicators that are not looking pretty, are just the symptoms of a problem, which is the illiquidity challenge that we need to address. So before we just go all focus on the symptoms, let's go to the core problem and see how we can address that. And if we can address that, then those symptoms will also be addressed. All right. So based on that, I want to go with my first question, that to the layperson who really doesn't understand some of the issues you just dimensioned, considering the number of economic obstacles that Nigeria faces today, all right, today almost everybody will talk about the fact that average prices of goods and services are skyrocketing. All right, they go to the markets, price of basic staple foods are going up by the day, right? So if you look at the challenges that the average Nigerian person is facing, as well as businesses, in the form of high inflationary pressures, high interest rates, forex fluctuations, low oil productions. We've talked about the liquidity issue from low federal government revenue, the increasing debt burden, and declining foreign investment. What are your thoughts generally on the performance of the economy? That is very clear. And what trends or policies do you anticipate will shape the performance of this economy for the rest of the year? I know you've dimensioned a solution, but based on what you've seen in the manifesto of the incoming government and what we've seen so far, what are your thoughts on the trends, whether these indicators that people really care about are going to change in a positive manner or in a negative manner?
Well, this is where the national governments have a choice to make. They have a role to play. Global shocks present, they are common, to all countries. Whether global shock spills over into the domestic economy or they are insulated comes down to what the government does. So, and this is something that Nigerians are looking up to the incoming government to press the reset button. So if central banks come out now and then and tell you they are hiking rates, or they are doing quantitative easing, or they are giving you forward guidance of, okay, this year we expect rate hikes so many number of times and stuff like that, they're all in an attempt to keep global shocks out of domestic space. This year, the whole world have seen, they've all suffered the food price and the energy price shocks. But different countries, have mitigated it to different degrees. In the face of the lockdown, different countries mitigated it to different degrees. The countries, and it comes down to the differences in the liquidity available to the countries. Countries with more liquidity, or countries with more, right, as we speak, the United States was one of the injected perhaps the most liquidity in the face of the lockdown. Now they are dealing with the challenge of a debt ceiling. Are we together? So it comes down to the ability, you insulate national economies with with liquidity buffers. So it's either you have the fiscal buffer, or the monetary buffer, or the forex buffer. And the way we've traveled, the last time we had a buffer to draw down on in Nigeria was in the face of the global economic and financial meltdown. We entered that crisis with 60 billion, in foreign reserves, and with a tidy amount, more than 20 billion in excess crude accounts. And so we were able to keep much of that negative impact out of national life. But since 2016, 2020, and now, everybody could see that there are no fiscal buffers, rather than the country having the fiscal resources to insulate the rest of the economy. The government itself needs to borrow from the rest of the economy, rather than the central bank having the fiscal buffer with which to steady the exchange rate. Well, they can't. Everybody could see that reserves are declining, and they could only restrict, do administrative exclusion to try and keep the troubles out. Are we together? So that's why we need to there's nothing you can do about what has happened in the past. That's why the new regime has to give priority. And you look at our peer countries. India is a top 5 economy in the world. Brazil has recently been a top 6, top 9, top 10 economies in the world before dropping out. They act with a stronger sense of desperation in the face of these shocks. They are never hesitant to say, okay, I want to sell off X% of this asset that I used to own 100% to attract FDI. I want to concession this number of airports, this number of rail lines, and they are getting the money in. They are connecting local assets to global liquidity. We tend to act as if there's no threat. You know, our governments lack a sense of urgency. We talk, and government acts as if there will always be time, and then they'll bring nothing. So in the space in 2016, 2017 that we have been talking about turning to assets, Saudi has unlocked so much. India has unlocked so much. Brazil has, from their national assets. They don't have more assets than us, particularly if we are considering idle assets. Okay, but we don't have that sense of urgency. I'm hoping that the new regime will show a stronger sense of urgency. Money answers all things. So whatever you want to do, education, health, security, at the end of the day, it comes down to what? To money. So talk more to us about how to get the money and how to get it quickly enough to stabilize the exchange rate, to fund growth, to fund infrastructure, and then perhaps Nigeria's narrative will change. Is the much that I would like to respond.
Thank you very, very much, Dr. Teriba. This is very insightful. Let me go to Mr. Nii Yusuf. Mr. Nii, so let's look at, I'm sure you've been looking at the manifesto of the incoming government. We just really need to be able to be proactively, figure out the kind of policy they'll be implementing. So my question to you is, with an incoming administration by month end, what key policy changes do you anticipate the new government would implement to impact the Nigerian economy, both in the short to medium or long term?
All right. Thanks, Josh, and good to be part of this seminar. Thank you for the opportunity. I think, like Leah said in his opening remarks, I don't envy the incoming administration because I think there's a lot that needs to be done in multiple ways and not just in one sector. But if I could speak to my own top 10 or top 12 areas where I will expect the administration to address and to address frontally, I think the first one is unity. And the unity of the nation. We are now very disunited, where it's very fractional and fragile country. So the government must take steps urgently to address the unity of the nation. Second will be around national security. We've got to have security either in the southwest or in the south-south or in the northwest or in the northeast or north central. We can't afford a situation where farmers can't go to farm and they are kidnapped, or where students can't go to school and they're kidnapped. No foreign investor, no serious investor will invest in a place where security of life and properties are not guaranteed. So national security is important. And I think on the back of that, my top priority areas will be around the stemming the production losses in the oil and gas sector. We've got to increase our production volume well beyond even what OPEC has given us. I mean, doing 1.1, 1.2, 1.3 million barrels per day, it's not okay for an economy that needs money. So there has to be steps to address the leakages, the losses, but also to promote further investment and oil production. That is important. And if you do that, that will give us a short-term boost in terms of revenue that will accrue to the government. Fourth will be a phased removal of subsidies in some form. And I think the incoming administration has been clear about that they will remove fuel subsidies, they will harmonize the foreign exchange and rates and remove the subsidies therein. And so some phased removal of those subsidies is important. I think there will be policy changes around creating some national public works program. They've talked about creating a national highway network that will link all the state capitals. But some public works program that will bring people on to work, that will take the youths that will get them engaged and busy. I expect that would happen. I expect there will be a review of a number of our trade restrictions. This idea of 41 or 42 items that are not eligible for FX, it's not sustainable. So I expect there will be some review of the trade restrictions, of the waivers, of the tax exemptions, because those are also things that are reducing the income accruable to government, and that will also lead to just plugging leakages to improve the finance of the federal government, improving tax collections. So corporates and individuals in terms of states will suffer the burden of, I think, a more rigorous tax collection regime that I expect will happen sooner than later, so that government revenues can increase. They've promised to address and initiate a student loan scheme, which will be good for education, which will be good for the masses if that can come on board. I expect some pronouncement around the commodity board. So part of what they've said is they want to put in place a commodity board that can guarantee prices for agricultural produce, minimum prices for farmers. So I expect that should happen in the early days. I expect there will be initiatives to attract investment, to promote PPP schemes. So Dr. Teriba talks about unlocking assets. We've not done a lot of asset unlocking or privatization or PPP in the last 8 years or so. But what we saw in Lagos State under Asiwaju, it's a focus on attracting investment, on attracting PPP schemes. And lastly, I expect some policy changes around the welfare of judges and judicial administration that can ensure that judges or justice will be fair, swift, and that can then help in terms of contract administration and make the country more attractive. So those are my top 12. I'll be happy if at least half of these top 12 are initiated in the first few months. Thanks.
Thank you very, very much, Mr. Nei, for your response. There's a good list of policies. Hopefully, if they're able to implement a significant number of these policies, I think there'll be light at the end of the tunnel. So let's look at some of the sectoral impact of some of these policies. And if there are policies that the incoming administration has indicated to implement that Mr. Nei did not mention, you are free to mention those policies that would impact the sector. So let me move on to Ms. Sheun Oni. How do you think these policy changes, either some of them, Mr. Nei has already mentioned, or if there are others, will impact businesses in your sector?
Okay. Thank you very much, Josh, and good morning to everyone. And I would first like to start by saying thank you for extending this invitation, and also to actually thank Dr. Teriba. That's an excellent, presentation. And I think one thing that struck me is I think the presentation amplified this whole conversation around reset. This is almost saying, you have to do something fundamentally different from what we've done before to really change where we are. I think to your question, we from a business side, we deal with the symptoms, unfortunately. It's the symptoms that speak, even to our transaction, to our income statement, and there's also a spillover even to the balance sheet. What most businesses have dealt with, is not so much of even lack of growth. It's shrinking margins and the spillover of the FX, inaccessibility to FX, the impact that has even on your balance sheet in terms of exposures. And you just need to look at the income statement of most organizations. You will see, apart from businesses that are doing a little bit of exports, you just need to see what has been recorded and booked in terms of income losses. FX losses, even in the year, before you look at the usual suspects around interest. So for me, it's immediately to those symptoms. They're all highlighted in what Mee has called out. I'm a bit bullish on subsidy removal. I think we're at a point where we need to move with a sense of urgency and with clear messages around what the intention is. Phased and then balancing phased with some form of quantitative easing and paying out, monies out, to people. I'm not so sure whether that, given where we are and the sense of urgency of what needs to be done. So for me, policies that quickly address, removing the inefficiencies in the FX market, of course, that speaks to complete deregulation. The windows don't help anybody. Let the market begin to drive the economy. So subsidy removal obviously speaks again to those rent-seeking opportunities that we've created, the arbitrage that also plays with that, linking to the FX issues. Security, again, just like Mee has said, I think that's absolutely critical. But security is almost like you're dealing with a multi-dimension issue. But I think it's in the language, it's in the what exactly the government does or says around security. Who are the people that are put together to start addressing it? How do they honestly and transparently talk about how they understand the underlying issues around security? From a layman, you can sit down and say, what does it take to clear a forest? It's as simple as that. So what exactly is their understanding of the issues and how they then intend to address it, I think will send a clear message. But to draw from what Dr. Teriba has said, I think it's some fundamental things that are articulated in the first 100 days and how that signals that there truly has been a change. Because a lot of the things Doctor has said are things that will have to take time to implement. But one thing that I think will connect it immediately are some of the institutional reforms. Capital moves to where it's open. It can come in and go out. And it also must have the confidence that there are institutions that can support sanctity of contracts and all that. So, the kind of policy statements, or I would say technocrats, that are immediately announced by the incoming government and the institutions that they will head, it will be a clear signal for capital to begin to pay attention to Nigeria while waiting for some of these immediate things around, removing the inefficiencies in the FX market. Interest rate is a fiscal, it's a monetary measure to address inflation, but it has a counter impact on businesses, right? So we have to live with that. But immediately when you start seeing things that will allow capital come in, you then know that some of these things will over time just ease out. So for me, I think the immediate things around, the usual suspects on FX, subsidy removal, and then how you really communicate how well you understand the security issues and the things you will do will be clear. And then really major shifts like Dr. Teriba has enumerated will begin to raise that signal for capital to start looking our way. I think I'll pause for now.
Thank you very, very, very much, Ms. Shewin. This is very insightful. So now I'm going to go to a sector that is very important in the Nigerian economy. Whenever the energy or the oil and gas sector sneezes in Nigeria, the rest of the country or the economy tends to catch cold. So similar question, but this time to my good friend, Mr. Kayode. So how do you think some of these policies that, the previous panelists have talked about and any other policies that you are aware of that the incoming administration has indicated they may or might implement would impact, the oil and gas sector?
Thank you very much, Josh. And thank you for having me here today. From my perspective, I think first of all, a lot has been said. And, I honestly share the sentiments of all those who have spoken so far. specifically for the oil and gas sector, which we all know is the mainstay of the economy today, especially if you are looking to either grow the economy. Today, the oil and gas industry has to be resilient for you to grow the economy. Or you are looking at diversification of the economy. You need a lot of money to do that. And today, the oil and gas industry remains the source of FX. And also, to improve the FX dynamics, you also need stability in this sector. And more importantly for me, to make Nigeria, an attractive investment destination, either for oil and gas or for every other sector, I think it's important that, you prioritize 4 key policy agenda from my perspective. Number 1 is security. I know a lot has been said about security, but for me, I think it's important to contextualize it, from the perspective of the oil and gas industry. If you look at what has happened in the last 9 months, for example, where at some point, Nigeria was struggling, to hit 1 million barrels per day of exports, right? Largely because of the losses suffered, across all the key terminals in the country. Today, we have seen significant improvements, especially on the western flank, the western flank of the oil industry, here in Nigeria. And what you notice is that, the government, NNPC, the security agencies and institutions working with private contractors have been able to improve the security situation there. Now, what do I want from the incoming administration? I would say that, the incoming administration has to consolidate on the gains that we are beginning to see on the security front in the Delta. And this has to be carefully managed, given the fact that we have private security contractors in the mix, to ensure that, we do it in a systematic manner so that we can avoid a repeat of what we saw in 2015, when the Buhari-led administration came in and launched a military campaign in the Niger Delta, which didn't end well. So we need more collaboration and we need to consolidate on the gains. The second point for me is fiscal stability. I think this is extremely important because we are now in a country where every year or so, there is a change, there are changes to the fiscal variables impacting on different sectors of the economy. And specifically for the oil and gas industry, at least in the last 5 years, I've seen the removal of the tax-exempt status for dividend income from upstream, oil and gas investments. I've seen increase in education tax. I've seen a significant deliberate policy to reduce the benefit of deploying debt financing to upstream oil and gas projects in Nigeria. And then, if you look at the Petroleum Industry Act, which potentially offers significant fiscal incentives, right? Potentially the incentives are attractive, but because we do not have a stabilization clause in the law, the questions investors, either local or foreign investors, will be asking is the government going to change the rules of the game in the middle of the match or not? So we need fiscal stability. And for you to drive foreign direct investment and reassure investors that Nigeria is open for business, you need stability on that front. So we've talked about subsidy removal. Yes, I do believe that subsidy has to go. It must go and it should go, given our fiscal situation and given the difficulties around subsidy. However, when we talk about subsidy, given the fact that, it's a socio-economic intervention, we have to think about how to ameliorate the pressure on those who really need subsidy. Because from what I know today, the low-income earners essentially benefit less than 5% from the subsidy, according to World Bank. And the big beneficiaries are the elite and our neighbors in other West African and Central African countries. So subsidy has to go for a lot of reasons. The other thing I will mention here, which is the last one for me, is there has to be some sort of improvement there has to be some sort of clarity on the regulatory side regarding the credibility of M&A process in the upstream oil and gas industry. That's extremely important. I mean, no investors or financier want to participate in a process that is unlikely going to close. If you look at what we saw a couple of months ago, where we witnessed conflicting signals between the regulator, the presidency, and the NNPC regarding the ExxonMobil transaction, I do not think we need such to continue under the incoming administration. So there has to be certainty as to what we need to do to ensure that processes close very quickly, and so as to improve the credibility of the market to drive FDI to the sector. So for me, those are the 4 key policies. And I think to the extent that, we are able to implement carefully measures to ensure that, we deal with these 4 key issues, the oil and gas industry is going to once again power the rest of the economy, to ensure that we convert the prospect of Nigeria under the new coming administration to prosperity. Thank you very much.
Thank you very much, Kayode. Thanks for highlighting these 4 key areas that are needed for the oil and gas sector, which we all agree is very critical to the success of this economy, whether you're looking at its contribution to revenue generation, or more importantly, towards the contribution towards forex, which is key and has rippling effect across the economy. So just to rehash, security, fiscal stability, subsidy removal, and clarity in regulations relating to the M&A process. All right. You're going to have enough time, later on to focus on some of these key areas as we move on with our Q&A. Let me go back to, the man of the hour, Dr. Teriba. So, Doctor, we've actually talked about, the fact that we really need to change our strategy, not only Nigeria emerging economies, and not over focus on, transaction policies that impact the income statement, but also look at our assets and make our assets generate additional revenue to deal with the liquidity issues. All the other macroeconomic indicators that are gloomy are just symptoms. However, a number of people do care about the symptoms because the symptoms that they tend to feel, all right, as opposed to the main source of the problem. So I'm going to ask questions around some of these key symptoms because that's what people are talking about today. And one of the key macroeconomic symptoms that is bothering people is inflation. In fact, it's not limited to Nigeria, it's global. So we cannot have a discussion on economic outlook without talking about one of the macroeconomic indicators that's bothering everybody. And the reactions of central banks to curb it, which, by and large, is consistent increase in monetary policy rate that has implications for nominal interest rates across the globe. So my question to you is on inflation. Some had believed in the Nigerian context that in December of 2022, when inflation seemed to have tapered off, right, when for the first time in about 11, 12 months, we had inflation rate actually kind of reduce slightly. I think from 21.47 in November to about 21.34 in December 2022, especially when it was supposed to be a festive period that you would expect that, inflation would have actually gone up. So there was a lot of excitement to the extent that come January, when the Monetary Policy Committee was meeting, people were, of different views, whether was the Monetary Policy Committee going to continue to increase the monetary policy rate, were they going to hold, or were they going to start reducing? Clearly, what we've seen since then is a gradual back to the trend of increases from January, that today we are around 22.22. So clearly inflation is a problem. It's a symptom, but we need to address it. So if you look at the fact that inflation continues to go up, Central Bank of Nigeria continues to increase the MPR, and therefore nominal interest rates continue to increase, what are the potential implications for businesses? And in your view, how can we as a nation, at least in the short term, start addressing this problem without having significant adverse impact on other sectors of the economy, especially when interest rates keeps rising?
Right. Well, you had you started by describing what is truly a global ripple effect of the geopolitical tension that the war in Ukraine represents. It's a problem that every country has had to grapple with, even those jurisdictions where inflation had historically been under control. You have countries who set a target of 2% inflation and had managed to keep the target for decades, now also dealing with inflation 5 times what they had targeted. That's down to the supply disruptions caused by the geopolitical tensions. Disruption to food supplies, disruptions to energy supplies. And unlike the time of the lockdown, that the lockdown meant disruptions to global demand. Yeah, you had broken supply chains, but the bigger problem was that even if we were able to push the supplies, who was going to buy? Everybody had been locked down at home. So this is seen as a cost push problem, this food price, energy price shock, not so much a demand pulled problem, which is the traditional problem that interest rate hikes might help you to curb. But in the face of the severity of the inflation, central banks around the world had hiked rates. Most of them are also awake to the fact that a recession looms around the corner. So they are not going to push the rate hikes too far, and they will stand ready to begin to ease should the recession become a reality. The contrast in Nigeria is that we suffer the food shocks, the food price shock. We suffer the energy price shock. We suffer exchange rate shock, which compounds the inflationary problem. So not everyone is experiencing 20% inflation. Some are still doing, single digits in spite of. And then we've been in and out of recessions, even while the rest of the world had been enjoying, some reasonable level of growth. So our central bank has joined the fray of tightening rates as if they belong to the class of countries that were coming out of monetary easing. The major central banks are hiking for the first time, in maybe half a decade, in a decade. We already had the policy rate at an elevated level, and we've almost outdone the others if you look at the basis points in which we have hiked. But our inflation is largely cost pushed. It's not demand pulled. Where is demand pulled inflation going to come from? If we believe the figures that have been thrown out there about the incidence of poverty, about the poverty head count, about the unemployment rate, so I'm not sure, so if the central bank or the Nigerian government could boost reserves such that Naira can be, stable, that the margins, the premium on the foreign, the private market to the preferred rate of the government could narrow. Inflation will dip. Inflation will drop back to single digits in no time, like we saw in 2017 when the exchange, the premium, prime market ran above 500, but then settled back to 360. Inflation tamed, and we enjoyed that until recently. So I think we have to look at Nigeria's problem, look at Nigeria's peculiarities, and not just join the fray. We never did quantitative easing. If you wanted to do quantitative easing, CRR will be zero. CRR is 32 point, is 1/3 of bank deposits. Our monetary policy rate, if you are not careful, is going to climb above 20% at the rate at which we are going. So we tighten, and that itself might compound the inflation pressure, because then the interest rate regime also becomes an additional shock to cost, instead of a relief, for inflation. And of course, the recession, are we talking about it? The weak growth? We're not even talking about the weak growth. And then we had the recent disruption, the currency redesign, that itself inflicted some supply shock, that if sellers can't get money, then they can't sell, which is not favorable to inflation either. So I think we need to coordinate policies, a bit more. We need our policy macroeconomic management agencies to act more in concert, rather than in silos, and therefore try and minimize the costs to shocks. If we could find a solution to the premium on the exchange rate market, and perhaps if the exchange rate is stable and inflation is coming down, we can also persuade the Central Bank of Nigeria, to ease the CRR regime, the cash reserve requirement regime, and the monetary policy rate regime, to give growth a chance, because growth itself, improved supply could also be, in the world of supply shocks, could dampen the inflationary pressures.
Thank you very much, Dr. Teriba. This is not easy. As Mr. Leah said in his introductory remarks, these are tough times, and you can't envy the government. If you're a CBN governor, you have two evils, that macroeconomic evils you are dealing with. Inflation being very high, and the tools at your disposal seems to limit you to increasing the interest rates, because you can't do much about the reserves in order to stabilize the foreign exchange market, right? So all you have to do is continue to, show some indication that I'm doing something by increasing what I have control over, which is the MPR, which also then has some unintended adverse impact on growth when unemployment rates are pretty high, 33%, if you want to believe the numbers that are presented out there. And underemployment is around 22%. So if you add the two, we are somewhere around 55%. So these are very interesting times. So thank you very much, Dr. Teriba, for your contribution on this. So I would want to move on to Mr. Neeb. Given all this high inflation and interest rates going up, at the end of the day, what is the impact on businesses, and how can businesses navigate these uncertain times? Because inflation impacts, and as Doctor said, it's a cost push type of inflation, meaning that it's coming from the supply side, production side, all right, which can then impact your margins if you cannot pass everything on to the final consumer in terms of higher prices to maintain your margins. At the same time, your cost of borrowing is also going up. So how can businesses navigate these uncertain times in the face of high inflation and high interest rates?
Thanks. And I think, beyond the macro issues, like and like we said in the last one, Nigeria also has its own peculiar geo issues. And so, like military strategists would say, this is what you call a VUCA period, a period of volatility, uncertainty, complexity, and ambiguity. And in such VUCA period, there are a few things to do. The first is just build your reserves. try and create buffers for yourself. So cash reserves, just build reserves. And the second thing will be to aim to protect your revenue, protect your cash flow. And you do this by focusing on your most profitable products, your most profitable customers. Just double down on them and focus on them, and make sure you find ways to protect your revenue. That is important. So you build reserves to protect revenue. This is also a period when you need to stay closer to your customers and improve your customer intimacy. So that when you improve customer intimacy, you get to know what do customers really need. Is it about affordability? And so that you can then adjust your product to meet the needs of the customer. You improve the product market fit for your product. But you can only do that when you know what the customer really do want. And so customer intimacy is something you need to continue to do. Stay close to the customer in this period. The same manner, you also need to avoid concentration risk, right? Avoid concentration risk through diversification. So ensure that 80% of your revenue is not tied to one customer. Because if that one customer then decides to slow down, then your revenue all of a sudden will slow down. So diversify your customer segment if possible, diversify your customer sources, diversify your product, or even diversify your geography, so that you are not concentrated in one geography. And as you do this, focus on reducing customer churn. Uncertain periods are periods when you want to retain your customers. And at the same time, you also want to retain your critical talents, your critical employees. And so it's a double thing. You must focus on retaining customers. You must focus on engaging and retaining also your critical talents. And in Nigeria, we talk about Japa syndrome, where most guys today are now seeking, they're not migrating. And so it's a high challenge for managers and the CEOs that I speak with. They worry a lot about how they can retain customers and retain their trusted staff. And so you will navigate better if you're able to reduce churn, if you're also able to retain your employees. It's also a period when you want to review your business model and see if you can become asset light instead of being asset intensive. So where is possible, outsource, where is possible, rent or lease. Look at an hybrid workforce. Most people come to the office space, or can they work from home while still managing productivity? That can help to reduce rent costs, etc. So work from home, digitalization is something to consider. Moving the number of items to the cloud from a technology infrastructure point of view, software as a service. So just look for ways to redefine your business model and reduce the asset intensity where it's possible. Do you need to own this warehouse, or you just want to lease a warehouse? Then find ways to protect your supply chain, so that you can secure the input of resources, inbound logistics, so that you also can secure that your goods can then get to the customers, can get to the market. So find ways to protect your supply chain. There are financial instruments you can leverage, insurance, hedging, do all of that. But I think the last and the most important, in my view, is to also have an anti-fragile mindset. If in the past we talk about being resilient, but I think now it's really about being anti-fragile. Anti-fragile means you're able to take advantage of disruptions to your own progress. So it's not just about absorbing shocks. It's not just about managing shocks, but it's really about what positives. How can I take advantage of the uncertain landscape? And so to have an anti-fragile mindset, you need to build automation. You need to focus on digitalization that can then allows you a bit of agility and a bit of flexibility in the way you manage your asset and you respond. So those are a mix of ideas that businesses can play with to respond to the uncertain landscape.
Thank you very much, Mr. Nee. Clearly, we are in a VUCA world. a lot of volatility, uncertainty, complexity, and ambiguity. And so we need to be very creative. And thanks for all the suggestions that you've provided for businesses. So those in the business sector, please, this is free consultation that you are getting from a top-notch consultant in this space. So please manage your reserves, build reserves, protect cash flow, stay close to customers, and try to deal with Japa syndrome, which is hitting me so hard. All right. So let me go to a specific sector that is important to this economy: manufacturing, industrial markets. Michelle, NE has provided, a plethora of, suggestions or recommendations to deal with these uncertainties. Let's be now sectoral specific. In your view and your experience as a CEO, what is your experience? What are your suggestions for participants, to deal with these uncertain times? Inflation is high, interest rates are high, we have brain drain. It's very difficult to even retain talent, and how do we deal with our customers? So your thoughts.
Okay, thank you, Josh. Maybe it's also good at this point too, because you really have been referring as manufacturing. We actually sit in the service sector.
Okay, sorry.
As a B2B, but I mean the context is, we sit in logistics, and almost that connects, manufacturing. You take out marketing, logistics is the second biggest cost. But I think one thing I would maybe like to just add, when you were talking about what happened, in December into January and inflation, let's not miss one important fact that also happened globally. China reopened. So there was actually, almost like an immediate improvement in the supply chain. And, just like Dr. Teriba said, if you still have your own fundamental issues, you will just see a little blip. Until you address your fundamental issues, you still don't address the big problem around inflation. I mean, like Nee said, a lot, cash is king. You focus on how you continue to protect cash. When he said the asset light, I smiled, outsource, because it's us people outsource to. So you take the assets off your balance sheet. And so what that means for a service sector or sector like ours in logistics, then efficiencies, how you drive operational efficiencies, then take a higher priority, because you are now actually sitting on a lot of, the asset base that the manufacturing sectors have outsourced to you, and you still have to deliver back that value. Not being able to pass on the cost you're taking on in interest for taking on that asset risk, the supply chain costs, just as we said, that's driving inflation. There's a limit to what you can unbundle back to your B2B, to your business partners. So the focus is really on operational efficiencies. One of the things we've done, I think COVID taught all of us a big lesson. You actually can't do certain things that you would never have dreamt of. Work from home has actually become a way of work in our own organization. And the key then is how you then build policies to ensure that productivity doesn't drop. So that became a key thing. But more importantly, linked to that was ensuring that we understood where the cost savings, where it happened, so that we could lock it down. And so that we see that flow right through into the financial. So it was really around operational efficiencies. Scale is also still very important. So what are the things you have to do, in terms of, managing your clients, your contracts to continue to grow revenue? It's instructive for us. We actually grew and tripled our top line last year. Because you can't carry the kind of asset structure and model without having to drive scale. The challenge is still margins, and that's why, like I said, operational efficiencies and what you're doing with some of those key cost line items. It's just unfortunate that the bigger costs still sit in energy. So when I begin to think what next, it's where, for me, it's what we see the incoming government do immediately on fuel subsidy, to start seeing those energy shocks how we can remove that, because we see, unfortunately, ours is not a PMS sector; it's diesel, right? And diesel has always been deregulated, but the volatility we saw last year was linked to FX. And again, the jury's out how much of that subsidy. So when we talk about, removing a subsidy and the impact on the common man, you start asking yourself how much of that subsidy is really translated to the true cost that the government was subsidizing. So I think we need to take a step and just be bold and do it and actually see, and then, see what really the real cost, of PMS. We saw what happened, when the diesel market was deregulated. The only volatility we saw came in, last year and the year before, when we started seeing, the volatility in the FX market. And we're doing this now. We missed the first window, when the government came in, when oil prices crashed. The next window now, I think, is now. So doing that, combined with, taking some actions on the FX market that I keep repeating, is what I think in our sector we need now. We're doing quite a lot to take away some of the cost pressures, but we're sitting on structural issues that are completely out of our control, and those are critical things that need to happen now.
Thank you very much, Seun. So we have about 10 more minutes for this panel discussion. We definitely have to respect the participants and look at some of the questions that they've posted. So please, this is going to be our final round of questions, and please be pretty brief with these responses, and these are coming from participants. So this is an oil and gas industry question, so clearly it has to go to Kayode, and I'm going to do it 2 in 1, right? The first question comes from Moshood, and it says, how does NNPC Limited by the new PIA affect the economy? Will it have positive effect as Aramco has Saudi Arabia? And the second one, even though it was directed to Dr. Teriba, I'm going to give it to Kayode because it's oil and gas. There are a lot of questions for Dr. Teriba that I'll ask later. So with Dangote refinery set to commence operation, how best can the energy sector be used to drive growth without necessarily inflicting pain of the dollar effect on the common man? So NNPC, Dangote refinery. The question goes to you, Kayode. I know you're going to do justice. Be pretty brief. Thank you.
Right. Thank you very much, Josh. I mean, if you don't mind, before I go into these 2 questions, I want to chime in a little bit on the subsidy matter.
That's fine. You can link it. Yeah.
So for me, I think before we start talking about the impact of subsidy, right, on the common man or the economy, as Seun alluded to it, I think it's important for us to contextualize things a little bit. Number 1 is to ask ourselves key questions as, the incoming administration continues to think about what to do with subsidy. Number 1 question is the issue of consumption. The reason why I'm raising this is because in 2011, we had a contentious number of 31 million liters a day. Today, we are seeing roughly about 70 million liters a day. That's a compounded annual growth of about 8%. If you compare that to vehicle population, growth in vehicle population in Nigeria over the same period, which grew at roughly about 2.5%, then you realize that clearly there's something wrong somewhere, in that equation. The second thing for me is, who actually benefit from subsidy. And I've said before, subsidy does not particularly benefit, the low-income earners in this country. It is the elite, the smugglers, as well as people living in neighboring West African and Central African countries who benefit from this. The third question is, can Nigeria continue to afford this? Clearly, the country cannot afford subsidy. Today, we are talking about a bill of 6 trillion. Mind you, the subsidy bill is a dollar-denominated, obligation or exposure. So if you realign your FX market, and for me, you put it at roughly at around 700, naira per USD, we are talking in excess of 10 trillion naira today. Clearly, that is unsustainable, and we need to deal with it. And the last one, which is very important, is how should we go about the removal? Because it's clear to everyone that you need to remove it. Today, I can tell you for free that if you do not address the issue of FX realignment, you can't deal with the petroleum subsidy issue. Because what you are going to have is that even if you deregulate the market fully and you do not realign the FX markets, what you're essentially going to do is to move the FX arbitrage from the bureau de change to the smugglers who are going to be taking FX subsidized petroleum products to neighboring African countries to capture the arbitrage. So in that sort of situation, then how should you then go about the deregulation? I agree with Neil that it should be phased. However, on one hand, you want to phase out subsidies so that you can improve the sustainability and financial condition of the country. On the other hand, you have people who are vulnerable. So my advice to the incoming government is that, you need to ensure that there are key milestone commitments that you need to agree to so that you can manage the social issues of fallout that are likely going to come if this is not systematically implemented. So what are those things? I mean, for me, I think if you are talking about removal of subsidy, you need to look critically into mass transit because, mind you, subsidy is a social intervention. The problem is that it is broad-based and you need to ensure that whatever you're subsidizing is targeted at those who really need subsidy. So mass transit for me, I think is one. The second point for me there is that you need to improve power supply because, I mean, the low-income earners are the people who go to the filling stations to buy fuel into their small generators, right? To the extent that, they can do away with those small generators and we all benefit from the scale of having a resilient grid. I think that, the shock or the pressure of removal of subsidy will be eliminated. The third thing for me is to have an auto gas, revolution strategy in this country, as we've seen in Ghana, where most of the taxi drivers essentially use an hybrid of gas and petrol to power their cars. And last but not the least for me is the residual removal of the subsidy so as to, engender the sort of behavior that is required, in the downstream sector of the country. So, I mean, when you look at that, then you start to think about, the impact of subsidy on the economy. It's important to mention this very quickly that, if you are able to get rid of this over time, we are going to see significant, the congestion of our ports in Apapa. And not just that, the pressure on our road is also going to reduce and on our borders, especially our borders with Benin, Chad, Niger, and the Republic of Cameroon. So I think removal of subsidy will help in that regard. Another thing to mention is that the moment you remove this subsidy, then you are going to see a moderation of the elasticity of, importation of or consumption, as the case may be, of PMS to vehicle population in the country. I think that, if you model the relationship, in terms of correlation of these two variables, which I think is important, to be honest, you realize that our consumption should stay between maybe 35 to about 40 million liters a day based on historical relationship. And the moment you remove subsidy, you're essentially going to see, a realignment of that relationship to something more plausible. Now, if you do that, then what that means is that in terms of your trade balance and the FX accretion and improvement in FX dynamics that you are talking about, we are going to see some sort of improvement because today, about 25% of your import bill as a country is for petroleum products. And based on the last statistics, that's between 10 to about 12 billion USD, right? You and I know that you remove subsidy, the volume of imports will reduce significantly. And as you do that, you also have certain logistics gain from that, which is going to be accretive for the economy. Yes, you do this, the 6 trillion that I mentioned will essentially disappear, even though you still have to have certain social intervention for those who really need it. And then debt sustainability metrics will then start to improve. So when you do all these things, right, you realize that, the government will have enough resources to essentially make long-term investments, that can power this economy. So I just thought I should talk about the subsidy issue very quickly, before I address the other points that have been raised. Now, on the issue of NNPC corporatization, yes, I think it's a welcome development. And First Hydrocarbon, for example, the company that I work for, we are in a joint venture with NNPC, and we are beginning to see tremendous mind shift in the way they do business. So I'm up for the corporatization, and I think that, corporatization of NNPC would actually position NNPC, as an efficient institution. And for me, if you look at the volume of reserves that NNPC controls today, I think NNPC, based on my own expectation, should be worth in excess of 60 billion US dollars, right? And if you are eventually going to unlock some assets, as Dr. Teriba rightly alluded to, you need to start that journey by, first of all, doing some sort of corporatization. So looking at it from that perspective, I would say that yes, indeed, that's a welcome development. Now, there's an issue, right? To the extent that, you do not have some sort of discipline that is required to remove subsidy and to also ensure that NNPC is super efficient, then Nigerian government is going to lose a significant leverage which we used to enjoy in the past. Instead of the government having a direct access to top line revenue, the government will now have to wait for dividend from NNPC. And I do not see NNPC being in a position where it can pay dividends to the Nigerian state if it has to carry this burden of under recovery because of subsidy. So I think that's that on the NNPC corporatization. And just very quickly, I think I need to touch on the Dangote issue, which is the last one. I'll make this very fast. I think that project, given the scale, we are talking about 650,000 barrels in terms of capacity of that refinery. I think it's a transformational project for Nigeria. And it starts from even the construction phase, where we saw over 30,000 jobs being created. By the time the refinery is commissioned, we are going to see direct and indirect, job of over 100,000 people, which I think is substantial, and that is going to be there for the long haul. But more importantly, is the fact that once the refinery becomes operational, then you are going to see improvement, over time in our balance of trade, as well as, the FX dynamics here. Now, it is important to mention that given the fact that bulk of the feedstock that are expected to go into the refinery are what we currently export today. So the $10 to $12 billion of import is not just going to disappear. What you are going to see is that the value addition from that refinery, the fact that, shipping costs, inbound, outbound will be reduced to the barest minimum, logistic costs will be reduced to the barest minimum, and the taxes levied by, countries where refineries where we import petroleum products from today will be eliminated completely, is where the benefit is. So that value addition and the multiplier effect, I think, is worth roughly about $5 billion today. I know that that is a moving number because we are talking about the commodities market here. So if you then look at the impact of that refinery on the countries across the region in close proximity to Nigeria, what you see is that, Ghana, for example, is going to benefit immensely from this, because all of a sudden, because Dangote refinery is located in a free zone area, in a special economic zone, there's no outbound tax that the Ghanaians have to absorb. Also, because of the scale of that refinery and the economies of scale that you're going to enjoy, you are going to essentially see a reduced cost, which is essentially going to be shared by the trading partners to Nigeria. So I think it's a win-win for every one of us, and it might actually position Nigeria on the path to self-sufficiency and improved, FX position at the end of the day. Thank you very much, Josh.
Thank you very much, Kayode, for your comments on this, the subsidy on NNPC and the Dangote refinery. So we've run out of time, but it would be unfair for us to end this discussion without posing this final question to our presenter, Dr. Teriba. So this question is coming from one of the participants, and I read, I'm quoting it. Excellent presentations, Dr. Teriba. Do you think the president-elect is likely to go the way of asset-linked borrowing or equity borrowing rather than debt, giving the usual credits to his potential pro-market orientations and giving the usual fear of selling the country to lenders? Or will domestic borrowings help douse concerns in this regard? So final question, Dr. Teriba, if you can take this, then we have our closing remarks.
I've gone through the Q&A, so I'm going to take these in addition to one or two others. I'm not sure that with the debt stock at 46 trillion as of December 2022, projected by the Debt Management Office to hit 77 trillion this year. They said by May. Depends on how soon they've got approval to securitize the ways and means, and it's not clear how much they've been able to borrow this year to fund the 11 trillion deficit. So they're looking at additional 33 trillion, but we're already paying 7 trillion in interest payment. You mentioned the revenue, budgeted federal government revenue of 10.5. Last year, we paid 7 trillion on interest payment, if you include the interest on ways and means. So if you are moving from 7 trillion of 46 trillion naira to interest you are likely to incur on 77 trillion naira. That's so from 44, which was the figure in September, to 77, you're adding 33 trillion. So you don't expect 7 trillion, as you are marking up the debt by 75%. So if you mark 7 trillion interest payment up by just the 75% that moving from 44 to 77 means, so at a minimum, you add, out of 7 trillion, you add, all the revenue that you expect in 2023 will go on interest payment. So I do not think that the president-elect and his team has a choice. You can't continue to issue IOUs that attracts the highest possible interest rates at home and abroad. You need to look for, lower interest. Then you don't have the revenue to pay. So you have better leverage it on investment. So it's an option that Nigeria has, but if you've not been using. And it's an option that if you want to find a way forward, you have no choice but use it. As a matter of fact, even going all the way to issue equity. But somebody asked the question that with the regulatory environment, do you think that investors, who commit so much to India, commit so much to Brazil, will they, given the regulatory, the attitude, but my answer to that is India became convinced that they need investment like more than a decade ago, and they have actually stepped up easing, the FDI protocols in their country over the past 7-8 years. So if the government is persuaded that they need equity investment, I think that they will then have the incentive to make the regulatory changes to provide comfort to equity investors. So in the past 8 years, Nigeria snubbed equity investors and courted portfolio investors. We wanted to borrow money. We wanted debt, either at home or abroad. We didn't want equity. So saying that you create a regulatory environment that will provide comfort to equity investors is out of the point. We are not looking for equity. So if we want to look for equity, I don't think we need to persuade, the incoming team. Somebody asked a question about NPR. That do we think that the federal bank should ease the NPR? The level that our NPR is, the level that the CRR is, if you mean to stimulate growth, are too high. It's not just in absolute terms, but relative to other countries. But the reason you should recognize, you empathize with the central bank. The reason that the central bank, keeps hiking or keeps tightening, the CRR is the fear of devaluation in the absence of a foreign exchange buffer. And the whole reason we are saying to the new regime, come to assets, unlock liquidity, not just to fund the fiscal pause, but also to create the liquidity buffer that will remove the fear of devaluation, that will enable the central bank remove the list of 43 items, that will enable them to be able to ease without any fear of it spilling over to the foreign exchange market, and that will enable them to free off the CRR. Basically, these are the points. They are all about options open to the country. Some countries don't have option. I mean, you've seen some African countries that have faced, been declared, junk, debt issuers. Some have defaulted. I don't think Nigeria is in that class. Nigeria has the privilege that we may not have the revenue, we may not have the income. We have the assets. And I can't count 10 countries that have the kind of idle asset stocks that Nigeria has. So if we could turn to the assets and connect them to global liquidity and unlock liquidity from there, it will help. Now, corporatizing NNPC it doesn't give you financial leverage. You begin to get the financial leverage. I like how this point is saying 60 billion perhaps, is what NNPC might, be sitting. Well, what gives the financial leverage is when you establish the market value of NNPC, or you establish the market value of any of the subsidiaries of NNPC, of maybe transmission company of Nigeria or Nigeria. When you establish market value, you open the door to motivating yourself to saying and doing things that will boost the market value. And it's only when you start boosting the market value that you begin to gain, make capital gains that you can leverage upon by having easier access to asset-based bonds, outside of Nigeria. I would like to, repeat, the fact that I appreciate the opportunity to engage with the distinguished panelists across the table, and I have benefited from the rich discussion that they have engaged in, and I thank the audience for their attention and for these questions, that they have raised about the conversations that we have engaged in. Thank you very much.
Thank you very much, Dr. Teriba. And thank you all very much to all the panelists. I think this has been very engaging, very insightful, and very educative. So big thanks to Mr. Nee, big thanks to Mr. Kaude, big thanks to Ms. Sheon for a very insightful session. I'm going to pass it on to my partner, my co-partner, Adeyemi Adederan. He's a partner in our commercial practice unit, and he's going to give the final vote of thanks and then we wrap up. Thank you very much. Dave, go ahead.
Yeah, thanks, Dr. Josh. Thanks so much to our panelists and the very engaging conversation with the participants. I mean, I couldn't leave my seat throughout the webinar because I didn't want to miss anything, you know. The conversation on what the new government needs to do was clearly spelled out. We need to focus on assets and not focus on the balance sheet and not on the P&L. We need to unlock the potential revenue that are tied into the assets that Nigeria has. So the key takeaway is to look at the asset and see how we can unlock the potential for revenue. Of course, we need to look at security, look at inflation, and to reset the economy. There are big decisions that the new government needs to take, especially with the fuel subsidy removal. I really like the analysis that Kayode made on looking at all those factors that would ensure that the fuel subsidy removal will become a success. You need to look at affordability, who exactly benefits from it. And you also need to look at consumption. It was interesting to note that there's a misalignment between the number of cars available and the consumption of fuel in the country. I want to thank everyone for your time. As Peter Doka said, that the best way to predict the future is to create it. I'm praying that we all be in the country and not Japa and contribute our own quota to create the kind of Nigeria that we all dream of. Thank you, everyone, and have a pleasant day ahead. Bye-bye.
Thank you very much. Thank you all. Bye-bye.
Thank you very much.
Thank you. Thank you.
Thank you. Thank you.
Bye.